Hi students, how are you? Today we are going to from today onwards we are going to discuss accounting standards. Okay, accounting standard. First of all, we start with the accounting standard, Sri Lanka accounting standard 2 or international accounting standards 2, IAS 2, SLAS 2, right? So in the inventory, right, inventory IAS 2 and SLAS 2, definition of the inventory is inventories are held for the sale in the ordinary process of the business, right? Inventories are the assets held or held by the person in the ordinary course of the business to in the process of production or such sales, or in the process of production of such sales, in the process of production of such sales, in the form of materials or supplies to be consumed, in the form of materials or supplies to be consumed, right? So if you say definition of inventories are held for sale in the ordinary course of business, that is finished goods, right? This is called finished goods. Finished goods. Okay, finished goods in the process of production of such sale, in the process of production of such sales. That means it is in the process of production, the production has not been completed, right? But the production is done with the aim of for the sale, right, in the ordinary course of the sale. Then that is work in progress. This is called work in progress. This is work in progress. They are mentioning this as a work in process in the form of materials or supplies to be consumed, in the form of materials or supplies to be consumed. That is to in the form of materials or supplies to be consumed, in the sense the raw materials for the intention of making the finished goods, right? Raw materials are consumed with the intention of the production of the finished goods, right? This is called raw material, right? raw Raw material, right? This is called raw material. So we have all three in the inventory. We have all three components, that is finished goods are there, work in progress are there, and raw materials are there. Three type of inventories. So that is inventory are held for sale in the ordinary course of business, that is finished goods, right? In the process of production of such sales, that is work in progress, right? And in the form of materials or supplies to be consumed, that is raw material. So have you got the idea of what is inventory, the definition, right? Second one is measurement, right? Measurement. In the measurement, what we call measure the inventory, measurement of the inventory, measure at lower of, right, lower of cost cost or net realizable value. Measure at lower of cost or net realizable value, right? That is the measurement. So you have to know what is cost, what is net realizable value. All these guidance given in the accounting standards, right? It is defined in the accounting standards, right? Measurement, how to measure the inventories. It is of course mentioned in the guided by the accounting standards. Measure lower of cost or net realizable cost means cost of purchase of material, the cost associated with the purchases of such material, right? Cost. And conversion cost of labor. Conversion cost may involve labor to convert that product or to convert that, upgrade that product. So you need the labor or machinery or anything, right? Machinery cost or labor cost. Conversion cost. Normally under the conversion cost, labor definitely will be there, right? And cost associated to bring the inventory to the present location and condition, right? Present location, right? Current location or present location, whatever it is, right? Cost associated to bring the inventory to its current location and condition or present location and condition. If these three conditions has to be satisfied for the cost should include all these three. That's what I have mentioned here. Cost incurred in bringing the inventory to its present condition and location. All the costs associated, right, to bring a product to the current present condition and location. All the costs associated. Material cost, labor cost, electricity, like that. Okay, this is the, and in the cost itself, this is the cost we have to involve. We have to include in the cost calculation of the product. What are the costs that we have to exclude from the calculation of the cost? That is overhead expenses which should be excluded from costs. What are the overheads cost that should be excluded from the cost are, one is selling cost. Selling cost, that means if you are appointing a sales representative, that is for him you have to pay the salary. Selling cost, that is coming under that. And other thing, selling and distribution, the vehicle cost to transport the item sold to the consumer's warehouse, that is also coming under the selling cost. Selling cost. So those selling costs should be excluded from the calculation of cost of the production of the goods, right? Next one is, right, this is next one is storage cost. Storage cost. After the production, okay, after the production of the goods, we have to store that goods in proper way in the storage or stores. The place called stores, right? Right? Stores. Okay. In the stores, we used to have a stores. To maintain these stores, we may have a expenses. That is one, staff expenses. Two, electricity for that premises, electricity. Third, water. And fourth one is to unload and upload, you must have labor, right? And you may have a security. So for the security you have to pay the money. So these all costs are associated to the storage cost. These are storage costs. This is storage cost, right? This is storage cost that has to be excluded from the calculation of the cost. You have to be very careful when you are calculating the cost of the production cost. And third one is abnormal cost. Abnormal cost in the sense the cost which do not arise in the course of the production, right? In the course of the production. So if that cost is not recurrent cost or not usually take place in the such production, then that cost is defined as a abnormal cost. Okay, that cost is defined as a abnormal cost. For an example, during the production you got a abnormal wastage, right? If you say in the production, if you have if you have allocated a 10% of wastage or 2% wastage, this is the 2% wastage normally used to take place during the production, right? This is the industrial norms, right? That is the industrial norms. So according to the industrial norms, we would have calculated the cost saying 2% we would have allocated for the wastage in the calculation of wastage. But all of a sudden, for the certain batch production, you got a 12% of wastage. 12% of wastage. It may be due to negligence of the staffs, or maybe due to fault in the machinery, right? That may be the causes, but this 12% of wastage should not be included in the calculation of the cost of the product, right? This is the abnormal loss and abnormal cost. This 12%. Normal is 2%. Normal wastage is 2%. So you have to take only the normal wastage of 2%, not the abnormal wastage of 12%. Understood? Okay. That is the abnormal cost. That is a good example for the abnormal cost. Next one is administrative cost. Administrative cost. What are the administrative costs? That is administration. sales manager's cost, and accountant's cost, invoicing person's cost, wages, right? Administration. The person who handled the orders, right? All those sort of things are administrative costs. Okay, these costs should not be included in the calculation of the cost of the production, right? That is only the cost associated to production should be included. Only the costs that are directly associated with the cost of production is included here. Okay, so that is the cost. This is the cost, how to calculate the cost. That is a measurement, right? Net realizable value is expected selling price, right? What is the expected selling price is mentioned, less estimated selling cost. Estimated selling price, expected selling price is there, and less estimated selling price, then we will get net realizable value, right? Net realizable, more in the most of the situation, net realizable value normally higher than the cost. Why? Because we are deducting from the expenses expected selling price minus estimated selling price, cost. So this is the way, whichever cost is lower, we have to take it. Okay. And other thing is, right? So this is the good explanation for the cost and net realizable value, right? Calculation of the net realizable value. In the question, they will give expected selling price, estimated selling cost also they will give. From that, you have to calculate the net realizable value. Here, on the cost calculation only, you will have some sort of complication. So if you have these three note, then it will be easy for you. 3 points. Okay. For measuring, right? Next one is, for measuring cost, unit cost should be used. For the measuring the cost, unit cost should be used. If cost can be specifically identified, if you can identify the unit cost specifically, then you have to calculate the cost on the based on the unit cost. However, if this is not possible, then the benchmark treatments are FIFO and average cost. FIFO, first in first out method, or average cost method has to be uh, adapted, right? You know what is the first in first out, you would have known first in first out and average cost, right? Average cost has to be there, right? FIFO is first in first out. First in first out means, if you purchase on 1st January 2023 and you are purchasing 2nd January 2023 and 3rd January 2023, these are the purchases, right? These are the purchases. Then if there is a sale, this is at the rate of, wait, this is at the rate of 10 rupees, this is at the rate of 11 rupees, this is at the rate of 12 rupees you are purchasing, right? When you make a sale on 4th of January 2023, you have to sell at the first first purchased on the 1st of January. Goods purchased on the 1st of January has to be delivered first. You have to give the priority for the purchased items at the beginning level. So 1st of January has to be taken first, and thereafter second, thereafter third, like that. That is the FIFO method, right? This is the FIFO method. Then first in first out, then fifth when the sales take place. This is sales, this is purchase, then this is the balance will have. Then if it is fifth on 23, you have to sell it at the 11. The stocks purchases will be delivered at the 11. Then what is the cost of the balance? Cost of stock is 12 rupees, at the rate of 12 rupees, right? This is the 12 rupees. Purchase at the rate of 10, we have sold it out. Purchases at the 11, we have sold it out on 5th. On 6th, we will have purchases done at the rate of 12. That has to be the cost of the goods. This is the cost of the goods according to the FIFO. According to the weighted average method, you will, if you issue the goods then and there without the organized way, then you can calculate the average cost 10 rupees, 11 rupees and 12 rupees. Then what you call 13 and 33. This has to be divided by 33 divided by 3. Then 11. 11 rupees is the average cost. Average cost is, right? Average cost 11 rupees. That means, and divided by 3 item, right? Then 11 rupees is the average cost, right? 33 divided by 3 equal to 11. 3 items, right? 1 2 3. Average cost is that. If you say delivered 10 rupees is delivered, then 11 and second and third is there, then 23 divided by 2, then 23 divided by 2, then that is 1150, the cost, average cost method. Okay, this is the average cost method. So for the measuring, that is what we have mentioned here. For measuring cost, unit cost or should be used, or if cost can be specifically identified. However, if this is not possible, then the benchmark treatments FIFO and average cost are to be used. Disclosure requirement. The accounting policy used for valuation. In the disclosure, we have to mention what is the accounting policy we have adopted in preparing these financial statements. That may be the inventories are valued at FIFO method or weighted average method, or there is the another one, group by group method or item by item method, right? And the inventory total analyzed appropriately. The inventory total is analyzed appropriately. That is, you know, how what are the group by group or item by item analyzed properly. The amount of any inventories valued at net realizable value. If the inventories, if any one of the inventories are valued at the net realizable value, then you have to mention that, right? The accounting policy used for valuation, which is cost or net realizable value. If the amount of any inventory is valued at net realizable value, if you value the inventories at net realizable value method, you have to mention that calculation of cost. Another method of calculation of stock in group by group or item by item, item by item or group by group. That is shirt. If you say for an example, for the shirt, there may be a different type of shirts or brands will be there. This is A brand shirt, this is B brand shirt, right? In the shirts you may have different brands, right? Here shirt item by item is A and A. Group wise it is shirt. It is shirt. Group, if you are calculating group wise, it is shirt. If you are calculating the cost item by item, means shirt A brand, shirt B brand, right? Shirt A brand cost is 750, right? B brand uh, net realizable value, sorry, B brand cost is 700, and trouser also like that, brands are there. C brand 3000, D brand 3500, and the t-shirt 550 E brand E, and brand F is 700, right? Net realizable value of this is 700, right? This is 650, right? Here if it is 700 and 650, net realizable value of this one is 3600. This is also 3600. Here net realizable value is 600 and 750, right? Right? Here, according to the item by item, shirt A brand net realizable is the lower than cost. Then we will take net realizable value of 700, right? Here shirt B, again net realizable value is lower. We take net realizable value 650. Group, this is shirt 1450, this is 1350, this is 1350, 1350. net realizable value is the lower. This is the group. This is the group by group item cost. This is the item by item and group by group. So 1350. In trousers, 3500 and 3500. Item by item, right? Item by item. This one is 3500 is the cost is lower. Here is net realizable value is lower. Here net in D, trouser D is brand is net realizable value is lower. Trouser D is cost is low. So we get 3500 and 3400. Here 7000 plus 7000 is the cost of the group 7000, and here also 7000. You say here if you make 300 1300, right? 1300 is lower. 1300 is lower, right? If you take this is 7000, this is 3000, 6900. Group cost is 6900, right? 6900 because 3500 and 3500 7000. Here 3600 and 3300 is the 6900. 6900 is lower than 7000. So here group by group is 6900. In the t-shirt, we get cost is lower. Cost is lower means here also cost is lower, no? Yeah, cost is higher and net realizable value is lower. Then net realizable value, cost is lower, then we will say item by item cost. Cost is lower, right? This one, net realizable value, in the t-shirt F, net realizable, this is 750, 700, net realizable value is low. If you say the group wise, 750 plus 500 is 800, 1300. Here also 1300. So we have to change it, right? So 700, this should be 800. 800, right? 800 and 700, right? Then 1000, this cost is 550 plus 800, 1350. Here 1300. Then 1300 is the is the cost, group cost. Here cost is where net realizable is lower. Here cost is lower, net realizable higher. So if we add this cost, right, total value of the inventory is 1350, 1350, 1350 plus 550 plus 700, 001, 8, 8, 13, 16, 2600, 3500 and 3300, and 11, 14 and 1, 9400, 9400. Here 650, 550, 1, 2, 8, 9500. Total value of inventory here as per item by item 9400, by group is 9550. Costing, cost of the inventory. This method also available. Goods by group by group and item by item. Right? Valuation of inventories. Okay. So I hope I have covered definition or recognition of inventory, right, and measurement, disclosure, okay, all these three parts are there, we have covered. In some other some items we will have definition and initial measurement, and subsequent measurement, right, and disclosure. Four parts are there. Okay, here no subsequent, we have not mentioned here subsequent measurement. So in a definition, initial measurement and disclosure, all the things I have covered in the inventory IAS 2. This is the IAS 2, you will be tested in the MCQs as well as in the accounts also. Okay, so with this I am concluding this session, and I hope to meet you in next session. In next session I am going to discuss IAS 16, that is property, plant and equipment, or SLAS 15, 16, sorry, right? So okay, take care, bye.